Welcome back. Today we're looking at an analysis report titled 3 Reasons Why I Am Bullish on UiPath Right Now. It lays out a really clear high-energy bull case. The argument is that institutional catalysts and a pivot to profitability have basically killed the old bear narrative.
They really have. And look, the tone is spot on. The data's punchy, and that argument about AI not killing UiPath is, it's very well done.
But there's a but.
There's a but.
To get this from just a strong analysis to a truly, a definitive contrarian thesis, we have to show that we've mastered all the risks, not just the big tech one.
Okay, so we're making the case bulletproof. Let's dig in, all right? First thing, while the material successfully neutralizes the primary long-standing bear argument that LLMs and AI will kill UiPath, the analysis could be strengthened by acknowledging and preemptively addressing non-AI-related market challenges.
I think I see the weakness already. The focus right now is very inward-looking, right?
Yes.
It's all about Q3 profitability, the success of agentic automation, and then that mechanical S&P 400 inclusion.
Exactly. And that company-specific focus, it creates a potential blind spot. It overlooks the external stuff.
Like macroeconomics?
Macroeconomics, broader competition, things that could still cause volatility, or, limit the upside, no matter how well the company itself is doing.
So a skeptic could read this and think, okay, you solved the AI threat, but what if there's a recession?
And they'd use that as an easy out to just dismiss the whole thing.
So the suggestion here is to introduce a structural risk, something totally separate from the tech conversation, and then just knock it down immediately.
Precisely. It reinforces that contrarian tone. You show them you're aware of all the pressures.
Okay, let's get concrete. The revenue resilience section. The numbers are genuinely impressive. 16% year-over-year growth to $411 million. ARR at $1.78 billion.
They are.
How do we bring in that macro skepticism without, sounding bearish ourselves?
That's the perfect place to do it. Right when you're talking about that resilience, you introduce the counterpoint.
Okay.
You could ask a question like, is this reliance on big enterprise spending on these high-cost workflow licenses? Is that really sustainable if we hit a major economic slowdown?
That's a good question.
Because it's a fact. If the Fortune 500 slashes their spending, even essential platforms slow down.
I see. So you ask that question, and then you point to the 16% growth despite the current macro environment.
Yes.
It changes the whole narrative. The resilience isn't just a number, it's proactive proof.
Now you're turning a potential weakness into a real strength. You show UiPath is already navigating that headwind.
Okay, what about competition? The analysis dismisses the LLM threat pretty well, I think, by framing UiPath as the essential governance layer.
It does, but we need to address the adjacent competitive landscape. The analysis brings up the rule of 40, which is fantastic. That's the gold standard.
Right, growth plus profit margin over 40.
But is that high enough, given the risk from these broader, integrated enterprise platforms?
That's the real challenge, isn't it? The adjacent threat. I can see, a huge player trying to just absorb that orchestration layer.
Not by building their own robots.
No, but by making governance a default feature in their own existing suites.
You've hit it. So you bring that question up. You ask, as I understand it from the notes, is the defensibility of that layer against adjacent competitors, say a Microsoft or an SAP, is it fully established?
And then you answer it.
And then you answer it with a single sentence about how UiPath's unique cross-platform nature is exactly why it can't be absorbed by a single vendor. It's platform agnostic.
I like that a lot. It makes the reader trust the bull case more because it's already withstood scrutiny from outside that AI bubble.
It just shows completeness. Okay, now let's talk about structure. The 3 reasons, they're individually very strong. But the way they're presented, it kind of dilutes the urgency. The narrative momentum gets lost.
Which leads us right into the second critique.
The strategic impact of the 3 main reasons could be maximized by sequencing them to reflect a natural investment timeline, moving from immediate catalyst to long-term vision.
Right. The material kind of presents them as equals, which makes sense on one level.
Sure.
But they have totally different time horizons. The S&P 400 inclusion, that's an immediate mechanical thing. It has to happen by Jan 2, 2026.
A hard deadline.
Yeah. And the other 2 reasons, profitability and agentic automation, those are much more foundational, long-term shifts.
And when you mix that short-term urgency with the long-term vision, you get this narrative dissonance. A reader doesn't know what to focus on.
It's like you're trying to sprint the first mile of a marathon.
You lose your pacing. You need to hook them now and then give them the reasons to hold on for the long run.
So the suggestion is a clear narrative flow. Start with the urgent action, then establish the financial foundation, And then you finish with the big long-term vision.
Exactly. It makes that energetic tone the report is going for feel much more authentic. Let's walk through it. We start with the mechanical pressure.
Okay, so we lead by highlighting the forced buying catalyst. We talk about that front run the stock saw, that 7.5% jump on December 24th.
And you have to emphasize that this is mandatory. Index funds, those huge passive ETFs like IJH or MDY, they must buy the shares. This is not optional.
It's a mechanical mandate.
A mechanical mandate forcing millions of shares to be bought. That's your immediate hook. That's why someone has to read this report today, not next month.
Okay, but I see a potential challenge there. If we lead with a short-fuse mechanical catalyst, does that maybe cheapen the long-term tech story? How do we make sure the forced buying doesn't overshadow the fundamentals?
That's a critical point. And the transition is everything. The forced buying is the shockwave that gets institutional eyes on the stock.
Right.
Then you pivot immediately to reason number 2, the profitability. And you frame it as the essential validation for that institutional interest.
So you're talking about the Q3 results, specifically that first GAAP operating income of $13 million?
You use that to give institutions permission to buy. Wall Street loves profitable growth. This pivot to positive GAAP operating income, which is the real measure, that provides the institutional floor.
It stabilizes things.
It stabilizes the stock. It makes the forced buying a long-term benefit, not just some volatile blip. Profitability is what makes the stock eligible to be a stable member of that index in the first place.
That's a perfect hinge. The profitability validates the inclusion, which leaves the agentic automation thesis for the grand finale.
You save that for last. You frame agentic automation as the core strategic vision. That's the engine for the massive 2026 run that the report promises.
The technological moat.
Action, then safety, then massive upside. That logic is so much more powerful.
That flow is absolutely critical. Okay, so now let's talk about making this all more actionable, making the data really jump off the page.
Which is everything for a data-backed report, right? If the analysis is high energy, the data has to be part of the action, not just sitting in an appendix.
So, third point, the powerful technical analysis, including the U-shaped recovery pattern and key price levels, currently resides as a separate bonus segment and should be integrated more deeply into the discussion of the fundamental catalysts to maximize the analysis's actionable quality.
Exactly. By separating out those key technical levels, the $16 support, the 1984 resistance, that 1716 breakout, it's a huge missed opportunity.
You're missing the chance to show how the fundamentals are actually showing up on the chart.
The reader wants to know when to act, not just why.
So we need to weave those specific price points directly into the fundamental discussion.
Let's start with that immediate action catalyst, the forced buying.
Okay, so when we're discussing the forced buying and all that volume coming in through early January, what's the chart's message?
The message is that the buying pressure has a structural goal. You connect that volume directly to the breakout at $17.16. That level was the top of a really messy consolidation range, between $15 and $16. So the goal of all this index buying is to definitively sustain that breakout.
So the price target isn't just some random number, it's the physical confirmation on the chart that the institutional buying is working.
It is. You're giving the index inclusion a tangible checkpoint. Now let's do the same thing for the profitability story.
Okay, profitability provides safety and comfort for institutions. How does the chart reflect that?
That safety is the floor. That's clearly laid out. I wonder, though, if we've considered how embedding the $16 level, that previous resistance that's now support, alongside the profitability data might make the institutional floor concept even more tangible.
So you're saying when we mention the $13 million in GAAP operating income.
Right then, you state that this profitability signals to conservative funds that the cash burn is over, and that conviction is physically visible on the chart as the strong support floor established at $16. The fundamental safety creates the technical floor.
That is so sharp. It connects the financial claim directly to the chart. And I assume we do the same for the ultimate target?
Yes, the long-term reward is clearing that big psychological level. The profitability pivot means the stock now has the institutional support it needs to ultimately clear that 19.84 resistance, the 52-week high.
And that's what brings the psychological $20 magnet into play.
Exactly. The institutional acceptance provides the fuel to break major resistance.
And I can see now how the U-shaped recovery pattern fits in perfectly there. It's not just a pattern on a chart, it's the visual story of the market digesting the old bear case and building this new institutional base.
That's the difference, right? You're not just presenting data, you're using data to craft a persuasive, actionable narrative.